Hi, it's Brad from Ocean Consulting Services, and in today's video we'll be discussing reasonable collection potential, how it's used by the IRS, and how it's computed. So first, some highlights. What is it? Reasonable collection potential, also referred to as RCP. It's a key to all collection alternatives, whether we're talking about installment agreements, offers in compromise, or currently not collectible status. It's really the amount the IRS uses to determine if you can pay your taxes and over what period of time. So just to back up a bit, IRS collection tools. The IRS can use liens and levies. This is the ultimate power of the IRS. They can take your assets that you own. They can force a sale of your house. They can take money that's held in your bank account, etc. They can also take future income. They can garnish your wages. They can take a portion of your Social Security payments, etc. But the IRS doesn't want to go to this extreme. Regardless of what you may think of the IRS, really this is a means of last resort. Typically happens when taxpayers really just ignore the IRS. They throw away the mail, they ignore, and suddenly they find their bank account's been swept or their wages have been taken. In virtually all situations, we've found that the IRS will discuss your tax debt ahead of time and will not rely on these methods of collection. So RCP, sort of the basics. First to understand is that this is a measure of cash flow. It's administered by the IRS, but it's not taxable income. So you really need to think about this in terms of how much cash could I generate today and how much will I generate in the future. As mentioned in previous videos, the IRS obtains what they call a silent lien. They basically, when the tax has been assessed and you haven't paid the tax, so it becomes a debt, they demand payment. They really step into your shoes. So anything you have a right to, the IRS has a right to. So the quick and easy way to think about this is, could I sell something, generate cash? How much cash would I have? The IRS has a right to that. How much can I earn in the future? Well, the IRS has a claim on that. Let's do an example. You have a home worth $300,000 and your mortgage is $225,000. So obviously your equity is $75,000. This is the IRS claim. The IRS does not jump ahead of other creditors. So the mortgage debt would get paid first. They would get the $75,000. Again, quick and easy way to think about it is how much would you receive if you sold the house, paid off the mortgage? That would be the $75,000. If you earn wages as an employee, they have a claim to those wages. They do allow you for basic living expenses, but they do have a claim on those future wages. So the concept here is that the RCP approximates how much the IRS could collect if they enforced collection. So if they used liens and levies, they took your property, they took your future income, that's sort of reasonable collection potential. The way to think about it is that's an approximation of how much they could receive if they engaged in forced collection. So some quick concepts regarding RCP. The beginning point is really a listing of all of your assets, your liabilities, your income, and your expenses. And again, this is not taxable income, so any expenses, housing, utilities, automobile, any income, child support, Social Security, wages, etc., go into this initial view of your cash flow income. The IRS then applies certain conventions and limitations on those amounts. So it's not as easy as just saying, here's a listing of my assets, here's a listing of my income and expenses, how much can I afford to pay? Some examples are with your assets, they employ what's known as a quick sale value, where they take 80% of the true fair value, and that's meant to approximate a quick forced sale of your assets. The flip side is that on the expense side, they impose many limitations. So for example, housing and utility, they'll allow you the lesser of your actual expenses or the IRS standards, and we frequently find that the IRS standards are the limiting factor. So in other words, even if you spend X, the IRS in this computation will only allow Y. So as mentioned, the IRS has certain rules. They can either help or hurt a taxpayer. Let's continue on with the previous example. We had a house worth $300,000. The IRS would take a quick sale value at 80%, so they would value the net value at $240,000. You owe $225,000, so the IRS would say you have equity of $15,000, even though in reality, if you sold it at true fair value, you'd have equity of $75,000. So obviously that helps you as the taxpayer. But it goes the other way. As mentioned, frequently the housing costs or personal costs are limited by IRS standards. So now that we've calculated RCP, how is it used? Standards are applied, conventions are applied. You calculate the impact on your outstanding taxes. So you're looking at the RCP. How much do I have in assets today? How much will I earn in the future according to the IRS standards? And I'm looking at now the statute of limitations. We mentioned this before. They generally have a period of 10 years to collect the taxes. So you're looking at how much cash could I generate today and how much over the remaining period of the statute of limitations. They look at that and say if that's enough to full pay your taxes, you won't be allowed most likely an offer in compromise, but you probably could pay your debt over time with an installment agreement. Well, that's it for now, an overview of RCP. Up next, our next video will discuss the detailed computations behind the RCP. Thanks for joining us, and as always, feel free to contact us if you have any specific questions or need help with resolving your IRS debt. Thanks, bye.